Stocks are getting more and more dangerous every day. I've gone over this in some previous videos. Um, when the banking system started to collapse, the Fed reversed course, started printing billions in QE. It did rescue the banks temporarily. I'll show you a chart of the banking system here in just a minute. But most of the money didn't really go into the financial system or the banking system. It's gone into the general stock market and specifically the tech sector. And it's produced this parabolic move here. And contrary to what most people tend to believe, when a rally just continues to chug higher day after day, people become more and more confident that the Fed has your back and that there's just no risk. Market's not going to drop, or if it does drop, it's going to be very mild. And that's just not the way markets work. So I've gone over this in some previous videos too. Is what happens as this rally gets more and more mature. You get more and more people chasing late in the rally, and so you're building up more and more stops as this sort of a semi-parabolic structure forms, and that's just a lot of stops to get hit when the profit-taking event begins. And so these intermediate cycles that right translate to an extreme degree, and so what that means is in the stock market generally, the intermediate cycles generally run about 20 to 24, 25 weeks, with 22, 23 being about normal. So the further the rally continues into that timing band, the less time you have for the intermediate decline to unfold. So if you got a rally that's rallying and next week's going to be week 19, you run out of weeks for the correction to unfold, and so what generally happens is it has to unfold very quickly, and you get some kind of a crash event. Instead of say a 6 to 8 week slow stair step down, it gets compressed into 2 or 3 weeks. So you get just this really big, I'm going to say probably a mini crash here in this market, as all of these stops start getting triggered from all the late buyers on the way up. So as I've said before, generally I don't expect a bottom until at least a 38% retracement. It can go deeper than that, but that's kind of my minimum. 38% retracement of the rally from where it's at right now, and you can see we're almost bumping up against this next major resistance zone, which was the first major counter trend bounce once the cyclical bear market began. So this is a spot to stop the rally. You can see we're starting to get some divergences here in the momentum indicators. It may have started on Thursday and Friday, but I'm doubtful that it's going to really continue Monday or Tuesday, probably after the FOMC meeting, where the Fed's going to raise a quarter point, but then I think they're going to say that they're going to go on hold, they're going to pause and wait and see. And so what happens is the smart money bought the rumor. So they've been bought down here, and they've been riding this rally. And counterintuitively, if the Fed says that they're going to pause, you would think that would be bullish for the stock market, except that's already been priced in. And so the smart money will be taking profits on the news instead of buying on the news. And then when that happens, you start triggering all those latecomer stops, and then it starts to snowball, and you end up with some kind of a major crash event down into that cycle low. So now let me go to the banking system and show you what's unfolding there and the reason why we've got this parabolic move. Okay, here's the BKX, the Philadelphia Banking Index. You can kind of the same principle applies on the downside. Price just got stretched too far below the 200-day moving average, and we've got a counter trend bounce that is trying to reel in some of that stretch, and it has reeled in quite a bit, but we're getting close to approaching this declining 200-day moving average, which I suspect is going to stop this rally. And even though the stock market is back in a cyclical bull market and making higher highs, the banking index is not. It's still making lower lows, and you just cannot have a healthy bull market in stocks if the financials are not participating, and they are not. Right now, this is just a counter trend bounce after a serious crash event that drove price too far below the long-term mean. We're reeling some of that in. There's going to be resistance at this pivot here, which we're getting pretty close to, and the 200-day moving average. So, as I said, we're getting late in the intermediate cycle, and when the intermediate cycle in the general stock market rolls over and we start to, as I suspect, probably get some kind of crash, then the banks are going to roll over and come down, probably make another lower low. So that's the Philadelphia. Now let me show you the regional banking index, which is a pretty similar picture. So again, and even more egregious in the regional banks. Those are the ones that, that's where the contagion is hitting first. It's going to spread to the major banks, and has. But same thing. We're just getting a counter trend bounce that's reeling in some of this massive stretch below the 200-day moving average. But, a long, long ways from making higher highs, not even close. Late in the intermediate cycle, when the stocks roll over, the regional banks are going to roll over as well. They're probably going to come down and make a lower low. And then the Fed's going to have to panic again, and they're going to have to print more money. And that's going to be very bullish. Well, it'll give the stock market a bounce, but I think it'll be very bullish for the commodity sector in general, and specifically for the precious metals sector. So that's what's going on in the stock market. We're nearing major resistance levels. We're getting late in the intermediate cycle, and price is stretched way too far above the long-term mean, setting up the conditions for probably a mini crash here in the next few weeks ahead. But probably won't really start until after the FOMC statement on Wednesday, where I think the market we're probably going to get some good news from the Fed that they're going to pause after this rate hike, and the market will probably sell that news, and we'll start the intermediate degree correction in earnest at that point.